Yes. So once again, say the very first topic, we say contingency theory in management accounting. And we say in management accounting, of course, there is a need that has been done to set a framework. And that framework is saying that for that framework in management accounting to be effective and for management accounting system itself, you know the definition of a system, a set of interrelated components or elements that work together to achieve a specific objective or purpose. So when we look at the management accounting system itself, we are saying the success and effectiveness of this management accounting system that work as a whole is dependent on various environmental, technological, and organizational factors. The theory is also saying that no one-size-fits-all approach to management accounting. What we are saying here is that there is no particular aspect that we will pick. If we go into management accounting now, and we say we are looking at CVP analysis, I'm just giving that example. That CVP analysis on its own is not sufficient to cater for every other topics we need to know in management accounting. But without wasting time, we'll be specific. The most effective system will vary depending on the specific circumstances and contingencies of each organization. And if you check your screen, you will see I've identified three contingencies there. We call them environmental contingencies, technological contingencies, organizational contingencies. How do we marry this now into the management accounting system? Of course, organization operates in an environment. And once you operate in an environment, you need to cater for the external factors that impact on the organization. One other name they call that one social responsibility accounting. And the environmental factors we are talking about when we talk of environmental contingencies include market conditions. Have you factored in the market conditions in the framework you are using for management accounting system? Another one is competition. Of course, competitors are there. Why do we talk about make or buy decision, close down or continue operation decision in management accounting? Because you have competitors, their price may be better than your own. Any attempt for you to increase the price, you lose customers. And sometimes you have done your analysis from the cost data available, you have looked at it, it's cheaper for us to even go and buy these raw materials rather than manufacturing, or to buy the finished good rather than manufacturing. We also have the regulatory environment. We operate in an environment where there are rules and regulations. So when you are developing that framework, you are expected also to factor in such rules and regulations. Then economic climate, that's another thing to factor in. Management accounting system need to be adaptable and responsive to these external pressures. That is, you are developing a framework for a management accounting system, you are expected to factor in the environmental contingencies. That's just a summary for the explanation. And if I want to give an example, in a highly competitive market, a system that provides detailed cost information and facilitates rapid decision-making might be more effective, which is true. That is, a particular organization is operating in highly competitive environment. When that particular organization do or carry out a detailed cost information and facilitate rapid decision-making, this will make them perform better than any other organization that is not doing this. Then we talk of the technological contingencies. Of course, here also we are saying the type of technology used in an organization will significantly influence its management accounting systems. Let's have a broader picture now. When we are saying, what do you even mean by management accounting system? I have just attempted the other time to define system. System has been defined as a set of interrelated components that work together to achieve a specific objective. When you now marry this with management accounting, it means the provision of cost information, data analysis, and any other relevant cost information for purpose of managerial decision making. So each of these cannot operate in isolation. I cannot say, for example, I have a unit that deals with CVP analysis. I have another unit, their own is budgeting system, and I want those units to operate in isolation. In fact, the combination of all the units that make up the management accounting department and the use of technology can be said to be the management accounting system. When we say a system, okay, don't let us go into system theory analysis now. And we are now saying for technological contingencies that your framework should make provision for technological contingencies. There's what is called real-time online. There's what is called batch processing. What our bank, some of our organizations do today, they call real-time online, is actually batch. They collect money from customers in the bank. I'm using a bank as an example. Then later, they key it in. I remember in those days when I work also UBA PLC. That should be 1999. Area 3, Gariki Abuja there. I was there in the internal control unit. They will bring all those papers, all those invoices, vouchers in bulk to the internal control unit. So the transaction has been done. They will now bring all the, but we're doing what they call call over. We'll be picking one after the other. But if another organization is now operating real-time, online real-time, means as this transaction is taking place, it is being addressed, being captured. So technology contingencies need to be factored in. And we give example here. If you use obsolete technology, or are you using the modern technology? Analog in an era of digital, you factor this. Companies with advanced information technology system might integrate their management accounting system with other information systems for better efficiency. Of course, the performance will be superb when we talk of digital technology rather than the analog one. Then when we talk of organizational contingencies, we are talking of factors such as organizational size, structure, culture, and management style. Those things also need to be factored in when we are talking of the framework, or we are talking about framework for management accounting system. Then, as you can see from our screen, the next major subheading there from our screen is implications for management accounting system. And the first item mentioned in that is adaptability. And for adaptability, what do we need there? We say management accounting system should be flexible enough to adapt to changing environmental, technological, and organizational conditions. I will take that again. If I want to explain adaptability, and we are saying implication for management accounting system, we have established that you operate in an environment that has rules and regulations. And what I advise people generally is this: change as time changes and adapt yourself to the environment. Change as time changes. So you have to adapt to all those environmental, technological, and organizational conditions. That is, you factor that in your management accounting system. That's the implication. Another one is customization. We are saying here, system should be customized to meet the specific needs of an organization, considering its unique contingencies. What am I saying here again? We have had cases, our consulting firm in Nigeria, when organization will invite us, come and help us install an accounting system. But what we normally do when somebody says, come and help us install an accounting system, some will say, we want to change from this current system to a proposed new system. And in system anatomy, that system life cycle is stage by stage. You carry out system analysis, you do system design. In system analysis, you check the existing system and justify the need for change. And when you now come to system design, even in that system design, you don't go ahead to do the output design without the input design. It's the input that will inform your decision about the output. So what we do when organizations call upon us, we want to change from an existing system to a proposed new system. Or they say, come and help us install a new accounting system. We carry out what is called need assessment. Need assessment in that, okay, what are you expecting? What are the outputs you are expecting from the proposed new system? So sometimes we use some accounting software. When they now tell us, okay, we need an accounting system that will be able to prepare a statement of comprehensive income, statement of financial position, and the rest. Or let me use management accounting language now. We need a software that will help us calculate CVP. We can do CVP analysis. It can do budgeting. It can do payroll. It can do forecasting. A lot of topics like that. It can do integrated accounting system. There is hardly any software that will do all at the same time. So this is where we will now go and sit down and customize, because in our team, we also have software developer. That's what we are saying here, customization. Then the next implication is integration. And we are saying integration here, effective integration with other business systems. Now, what is the relevance of management accounting system that you have developed that cannot interact or that cannot be integrated with customer relationship? So we have what is called CRM, Customer Relationship Management. Organization will deal with clients. So the management accounting system you are going to develop must be one that will be able to integrate with CRM or ERP. What do I mean by ERP? Enterprise Resource Planning. That's the explanation. And the last point there, strategic alignment. And here the explanation we just need is that the design and use of management accounting systems should align with the strategic goals of the organization. Ladies and gentlemen, if you want to take a recap of what I've said so far about this topic now, contingency theory in management accounting, we are saying for management accounting system to be effective and efficient and to give us desired results, there is a need to develop a framework. And in developing this framework for the workability of the management accounting system, we have some contingencies that need to be taken care of. And from these contingencies, we have identified, we have the environmental contingencies. An environmental contingency, we are saying organizations operate within an environment and they need to factor in all these contingencies from the environment. We have technology, because the kind of technology you use will also affect the effectiveness of operation of the management accounting system. If you go and start using analog in an era of digital, your competitors will leave you behind. Then we say organizational contingencies. There are also factors. What is the management style in the organization? And that same organizational contingencies, we are asking the question, what is the structure of the organization, organizational structure? What is the size of the organization? An organization that is just small in size now, and you decide to go and use sophisticated technologies that you don't even have the technical know-how, of course, they will have problem. That is topic number one. See my conclusion there. In essence, the contingency theory underscores the need for management accounting systems to be dynamic. See, dynamism here means it should be flexible, it should be able to change as time changes and tailor to the specific needs and circumstances of each organization rather than relying on a standardized approach. That's topic 1. Topic number 2, I'm still going to give us this slide. I will share notes with us later. Topic number 2 is focusing on institutional theories and management accounting. Remember this course title, Advanced Management Accounting Theory. Some of you will be doing your dissertation or thesis and you want to go into management accounting, especially when you come to your literature review, you'll be expected to talk about some theories like that. Very, very relevant. Institutional theories and management accounting just refers to the application of the institutional theory concept to the field of management accounting. Why are we talking theory? Theory is the basis for practice. Until a particular area has been theorized, when they say something becomes a theory, tested by experts, by renowned scholars, by researchers, and they now pronounce it, they postulate, they say, this is no longer a postulation, it is now a theory. Institutional theory, a prominent perspective in organizational study, examines how social and cultural factors influence the structures, practices, and policies of organization. Now, ladies and gentlemen, our focus now in this institutional theory should be what? Should be looking at the cultural factors and how they influence the structures, practices, and policies of organizations. In the concept of management accounting, it explores how these external forces shape accounting practices and decision-making processes. And I've itemized here from the screen, as you can see, we have some key aspects of these institutional theories. I'm going to take them one after the other and explain. Let's see them first. We have the normative pressures, mimetic pressures, coercive pressures, cultural and social influences, technological changes. Then we have organizational feed and change, resistance to institutional pressures. These are the core aspects we need to look at when we talk of institutional theories and management accounting. Remember again, what is the objective here? What are we trying to achieve from this topic? We are saying we are looking at a prominent perspective in organizational studies that examines how social and cultural factors influence what? The structures, practices, and policies of organization. Remember, no nation operates in isolation. No nation or organization is an island of itself. As a matter of, okay, don't let me digress too much because of our time. Sometimes I look at Nigeria. Of course, Nigeria itself is a system with different components. So the same thing, an organization, especially when we say formal organization, you don't operate in isolation. Brief explanation, when we talk of normative pressures, what we are saying here is institutional theory looks at how professional norms and standards influence management accounting practices. That's sufficient. In normative pressures, we are saying this theory consider how professional norms, professional rules, regulation, ethics, how professional ethics and standard influence management accounting practices. Of course, this one includes the role of professional accounting bodies. Do we have management accounting association, for example, in Nigeria? I know we have CIMAs, Certified Institute of Management Accountant, or is it Certified Institute of Management Accountant, CIMA London, CIMA UK, and so on. So what are the standards published from time to time? That one has to be factored in. And whatever standard issued from time to time, of course, will affect the various practices. Now we have the mimetic processes. That's the second one. If you look at mimetic processes, the organization often imitate the practices of other successful organizations in their field. This is not mimetic, just like mimicking, you mimic something. Imitation, you mimic. It's also known as isomorphism. Isomorphism. In management accounting, this could involve adopting budgeting techniques, performance measurement system by industry leaders. There is nothing new under the earth. If there is a key point you need to remember there, it's just from the word mimicking. You want to adopt what others who have gone ahead of you, or those who have results to prove, those who have results to show. You want to adopt some of their practices. Maybe they have a budgeting technique they are using. Is it ZBB? Is it traditional budgeting? As long as you have a proven result, or they have a proven result that is giving them what they want. Then we have the other one, coercive pressures. So these come from regulatory requirements or government policies. See the difference. The first one, normative, has to do with the professional norms, the standard released by professional. The second one, you are mimicking, or you are buying from the ideas of other firms in similar industry who have gone ahead of your own organization. Now we say the other one, coercive pressures. This one has to do with government, such as tax laws, regulatory framework, and so on. Then we have cultural and social influences. Here we are talking of impact on accounting practice that is arising out of the culture. And I'll give you an example here. Culture here includes societal values, beliefs, and expectation about transparency, ethical behavior, and corporate responsibility. I'll take that again. In cultural and social influences, our focus should be how culture and social influence and social occurrence or social values, societal values affect management practices. And to be specific now, and I say this include the beliefs, the expectations about transparency. In fact, in auditing, we have what is called expectation gap. Expectation gap is what is expected from us as auditors, and that's the expectation from stakeholders or society now, and what we are doing. And we find ourselves in an environment, all manner of societal values or good values has been lost. Then what are the expectations when we say transparency? All these will affect our management practices. The next one is technological changes. And in technological changes, what we are saying is institutional theory should acknowledge the impact of technological advancements on organizational practices. So what we are saying about this theory, what are we going to factor in when we are talking of improving management practices? That's what institutional theory is focusing on. And we say in management accounting, this involves the adoption of new technologies for data collection, analysis, and reporting. Very straightforward. If you still say as a manager or as an organization, all your data collection, data processing, you want to do it manually. In this era that we are talking of data analytics, that people are saying data is life, that organization is not ready to go forward. It's one of the reasons, as a matter of fact, that we have a lot of organizations today doing wonderfully well before the advance, before the coming of digital revolution. But now, because they cannot meet up, they are obsolete and they are out of work or out of job or out of operation. Then we have organizational field and change. The theory emphasizes the importance of the organizational field. That's the wider system of organization now. And changes in management accounting can be driven by shifts in this broader organizational field. Let's be specific. We say for organizational field and change. The importance of this particular theory is that it concentrates on organizational field, the wider system of organization that influence each other. I'll give a practical example. In financial accounting, even management accounting, we talk of departmental accounting. As an organization, when you are looking at a system, the whole picture, that as a whole, of course, we have components that make up the whole management accounting system. Now, when concentration now is on each department and how they affect your management practices, that theory is talking about the organizational field. The last one is resistance to institutional pressures. While institutional theory often focuses on conformity, you want to conform to the normal norms. Say, when you're in Rome, do in Rome as Romans do. That's conformity now. It also recognizes that organization may resist external pressures. Can we get that now? That is, when you know your onions as an organization, you know, okay, I've obeyed the rules and regulations in place. Don't allow external pressure to affect what you know is good for the goal of the organization. That's why resistance. That's all that. But in conclusion, we're saying understanding this aspect is crucial for comprehensive grasping how institutional forces shape management accounting practices. Now, what I did, if you look at the next slide, so one of the key concepts in this area is isomorphism. I mentioned that this describes the process by which organizations in a particular field tend to become more similar over time as they respond to similar pressures and imitate, we have mentioned that imitation before, other practices. And we say we have three types of isomorphism. Coercive isomorphism, I've explained this, mimetic and normative. If you have taken note before, we have already explained this. Coercive, mimetic, and normative is the normative we say by professionals, the rules and regulation, what we just explained now. Topic number 3 now. This should be topic number 3, not 2. Critical theories in management accounting. Critical theories in management accounting. So far, so good. See what we have done. Contingency theory in management accounting. Seen that, how environmental contingencies, technology contingencies, organizational contingencies affect the framework which form the basis of developing management accounting system. That's what we have seen. There was institutional theories and management accounting. For us to be on the same page, let me quickly also see. I'm sure we'll all have the course outline. Contingency theory, institutional theories, critical theories. I'm correct. This is the next one. Critical theories is what we are looking at. Ladies and gentlemen, what you will do shortly, you will reconnect with the same details I've given to us. You get me? So this one has a maximum of 40 minutes. I've not subscribed, so I have to extend the timing. So we'll come back. Let me go Zoom. That's in case it log you out, is the same you will do. Meeting. Edit. I cannot edit until I end this meeting.